There's a shift we're seeing in markets that reminds me of the speculative frenzy we saw during the meme stock craze 4.5 years ago. Hello, and welcome back. I'm Robert Amato, principal at Compass Wealth Management. As you may recall, stocks like GameStop and AMC experienced a surge on social media hype rather than on fundamental factors. We're now witnessing a new wave of similar behavior. Companies like Krispy Kreme and OpenDoor are the latest so-called meme stocks, with prices jumping wildly despite weak business outlooks. This kind of speculative trading tends to resurface when market sentiment becomes overly confident and risk is being mispriced. And while that may offer short bursts of excitement, it usually doesn't end well for the speculators. At the same time, there's been a quieter but more meaningful trend unfolding, a growing rotation away from the Magnificent Seven, mega-cap tech stocks, and into more reasonably priced, value-oriented sectors. Based on the recent headlines and trading data to back it up, individual and institutional investors are increasingly questioning whether current valuations in big tech are sustainable. Many are shifting into sectors like utilities, financials, and industrials, companies with stable fundamentals and lower price to earnings. Look at this chart from JP Morgan comparing current valuations of the Magnificent Seven to the rest of the market. As you can see, the gap is substantial. These 7 stocks are still trading at elevated levels, while the broader market looks much more attractively priced by comparison. We may be seeing how the benefits of AI could be moving from the companies that provide this technology to the broader economy. This brings us to our strategy at Compass. We've been intentionally equal weighting value and growth sectors in our client portfolios, in contrast to the S&P's natural tilt of 2/3 growth and 1/3 value. This adjustment away from overvalued growth and into more balanced sector exposure has helped us reduce risk while still participating in market gains. So far this year, this approach is working very well. Clients have benefited from less volatility than the broader market without needing to chase risky trends or overpriced stocks. And based on everything we've discussed, the return of speculation, the relative value of sectors, and investor rotation, we believe this strategy remains well positioned for the second half of the year. If you'd like to discuss how this is playing out in your specific portfolio, do not hesitate to reach out. And thank you for tuning in. Hi, I'm Robert Amato, principal of Compass Wealth Management. If you found this video helpful, go ahead and give it a like, subscribe to our channel, and hit the bell icon so you don't miss future updates. If you're curious about how we help our clients get the most out of retirement, click the link in the description below to connect with us. Thank you.